Well, welcome to this special summer series conversation with the CEO of Keefe, Bruyette & Woods, a Stifel company. That's right, I'm talking with Tom Michaud. And first, Tom, I have to say, we usually put our coats and ties on when we see each other. Here, I appreciate we're taking just a more casual approach to the summertime, but I know what we're going to cover is not casual. It's really important for officers and directors across the United States. So thanks for giving us a few minutes of your time.
Al, great to be with you.
Well, it's always a pleasure. And for those of you who have been out to Arizona and our Acquire or Be Acquired conference, you recognize that Tom does just a magnificent job of setting the table for the 2.5 days worth of conversations that take place in the Arizona desert. I'm fortunate to be able to work with him on the agenda over a period of months in advance of the conference taking place. And we thought instead of waiting to get out to the desert in January, we should really try to surface some of the key issues that are front and center right now. So, Tom, I have maybe 3 or 4 things that are on my mind that I'm curious to get your take. Okay?
Sure.
All right. Well, it's earnings season, and we just saw the results from the second quarter. Curious just to get your take on kind of industry trends and the big picture.
Sure. So when I presented at the conference back in January, I talked a lot about negative operating leverage that was currently in front of the industry, and it looked like it was going to be the case for a period of time. Well, we're seeing that right now in the second quarter, even more so due to the global pandemic and the fiscal and the monetary policy. So because of the low rates that are in the marketplace right now, and frankly, the weak loan growth outside of PPP lending, we're seeing pressure on revenues, and we expect to see that continue later into the year as well. The second important trend, I think, is credit quality, because unfortunately, we're going through this pandemic in the first year of a new accounting practice called CECL. And so there's a lot of new information coming out as to how banks are approaching their loan loss reserves, and it's new for investors and other industry observers. And so that's got investors' attention as well, because some banks have elected to defer. Other banks have elected to enact those provisions. And so there's some degree of uncertainty because the provisioning's happening now, but the net charge-offs really haven't shown up. We are seeing an uptick in classified assets. And there's also a lot of uncertainty around deferrals and how these deferred loans are going to behave when the deferral period is over, or possibly when the government stimulus ends.
Yeah, and so I've been paying attention to some of the different indices that are out. Obviously, the Keefe Banking Index is a really important one to pay attention to. I've noticed it's down about 30% on the year, which is interesting when you look at the S&P, which has been relatively flat. Why do you think it is that investors have basically left some of these bank stocks behind?
I think it's for 2 primary reasons. I think the first one is fundamental to the banks themselves, which, like I said, revenues are a little bit challenging because of the current environment, and there's uncertainty around credit quality. I also believe that the Fed policy around adding an earnings test to the nation's biggest banks introduced a little bit more uncertainty to dividends, which has made investors more cautious, even though it's our opinion that over 90% of the banks that we follow ought to be able to earn their dividend and not have a problem with the dividend, but there is still some concern about the dividend. The second thing is we're in the middle of a tremendous wave of investor enthusiasm around growth stocks. There was a moment in time recently where there were 4 American companies whose market cap was pretty similar to the Japanese stock market. It's incredible at this flow of money into growth stocks, and financial stocks are not growth stocks. And so there's been a big style play with passive investors away from financials. And in my opinion, it's left the banking sector oversold. There are some very good super regional banking companies in particular that trade at 85% of tangible book. They might have a 5.5% dividend yield, which we think is likely to be safe. And we're looking at 2022 as the year where maybe we get back to a more normalized earnings approach for the industry. Now, it won't be a great year of earnings, but if we stress test that year a little bit and come up with our view of what normal is, these stocks are trading, some of them at 7.5 times that number. Meanwhile, we've got a stock market that's at an all-time high. So my view is that a lot of these stocks have a lot of bad news in them. And if you're a long-term investor, it's my opinion that they can be good investments.
Well, let's stick with that kind of long-term view, and actually maybe it's medium to long-term. So, I think about where we're coming from over the last 3 or 4 months. How has the pandemic really maybe shifted your focus or your outlook on the financial sector in the medium to long term?
Well, I think the first thing is that it's probably accelerated trends that were already underway, in my opinion. So
Okay.
let's talk a little bit about digital engagement and the customers of banks. I would point viewers to the US Bancorp conference call and the First Republic conference call that just happened. Both of those management teams talked about the acceleration of digital engagement with their clients. E-Trade has said that they had more new accounts signed up in the month of May than they did all of last year. So it's really incredible to see what's happening. And there are still plenty of branches that haven't reopened since the start of the pandemic. And there's a question about, will some of them never reopen? I think the future of the branch was already directionally changing, but I think that this moment in time will probably accelerate that. I think that you're going to see banks take a new approach to cost control, and that they're learning more about how their employee base can work remotely and could possibly find expense savings there. And then lastly, I think that the trends towards consolidation will only be accelerated once we get stability later in this cycle. You'll see consolidation pick up, mainly because bigger banks have been more profitable, we think are likely to be more profitable. Banks that are solely spread dependent for their income are going to be more challenged with what we think the monetary policy is going to be for the next several years. And these are some of the features I think that could lead to more consolidation.
Yeah, well, let's maybe stick with the consolidation conversation at the moment, because if you look back just a few months ago, those proverbial mergers of equals, where you saw like-sized institutions coming together to create some really interesting new franchises that can compete on a more regional basis, were being announced. It seemed like that was the direction that a lot of institutions were at least considering. And part of that goes to the technology opportunities that they could try to pursue. So you've kind of given me two different trains of thought. I want to talk fintech next, but right now I'm curious your M&A outlook.
So I think you're going to see probably more of what was happening pre-virus. I think you'll probably see generally lower premium deals, because I think that the buyer shareholders know that, or the management team know that those deals need to work for the buyer shareholders. And I think also too, there's really not a long list of buyers who are willing to pay much of a premium. So I think you'll probably see deals being done like the ones that were done pre-virus. But what we need first to have happen is you need to see credit quality stabilize. There still is too much uncertainty, and in my history with the industry, those have been periods of time where consolidation slowed. And then lastly, if you're curious as to who the buyers are and who the sellers are, typically the buyers have a higher price to tangible book value than the sellers. And I would go looking for those two categories if you want to sort out who was going to be where.
Yeah, well, thanks for that. And then, as I said, I'm also thinking about technology and its intersection with traditional banks and the way business is being conducted. So, you can talk about fintech in a broad sense, but I'm curious if you were to look at the fintech area and say, this is the one part that I think is really hot right now, what would it be and why?
So I think it's payments. If I were to build a pyramid of fintech and say who sits on the top, I think it's payments, because I think there's a very good chance that the consumer or the business that's receiving a service thinks that whoever's putting it up on their website or connecting with them digitally is who they think their bank is. And so much of that happens at the payment point of sale. Plus, the amount of information entities can learn about payments from folks' behavior is really remarkable. So I think payments is a very hot space and will continue to be. I also believe that any technology that can enable financial institutions to be more efficient while more of their employees are working remotely is important. Something like nCino, for example, which recently went public, is one such vehicle that can do that. And then I still believe that deposit and client gathering is really important. And I think that fintechs that can help banks do that will continue to succeed. So those would be the three areas that I would highlight the most.
Yeah, I think you're spot on. And in fact, for viewers who are interested, we talked a little bit about MasterCard's recent purchase of Finicity, and also Plaid buying or Visa buying Plaid, because you look at some of these large payment companies that are opening their wallet to make significant investments in this open banking world that we're moving towards, if we're not already living in. So I think Tom's point is really well placed. So we've got time for one last question. We're less than 100 days until the election. It would be hard for me not to ask if you have some ideas or just thoughts on what could happen to banks given, different outcomes.
Well, I think if the president were to win re-election, you'd probably see something similar to what we've seen over the last 3.5 years plus, which is, I think, a more measured approach to Dodd-Frank and trying to modify many of the rules. I don't think there's been really anything tremendously revolutionary about changing the rules, but really trying to right-size what was written in the Dodd-Frank bill. And I also think that you would see a lot of interest in returning Fannie and Freddie to the private sector. If there was or is an administration change, I think there are a couple things that could be important. Number one is candidate Biden, Vice President Biden, has published a new tax plan, and we have studied that plan. And if that plan were passed as presented, we think it would cost the banking industry about 9% of its after-tax profitability. So that's a key important feature. The other is that many of the Democratic primary candidates had very detailed thoughts about the financial services industry. And if any of them found their way into the cabinet, I think you could see that there would be a more aggressive approach to regulation, both of an interpretation of the current rules as well as possible new rules that could be passed. And then I think if Fannie and Freddie were to go public under a Democratic administration, you might see it have a different form than it might under the current administration. So these are some of the key differences I think that could play out if there was a change in administrations.
Yeah, well, we appreciate that. And really, Tom, we appreciate just your perspective. If you, again, have been out to Arizona, Tom does, has a lot to share. And we've asked him to condense his comments, for this particular video down. So appreciate that. Appreciate you. Good luck to everyone on your team over the next few months. It's certainly going to be interesting times. Everyone who's been watching, thanks for joining us for this AOBA Summer Series.
Al, thank you for having me. Be well and stay safe.
Thanks. See you soon, my friend.
Yes, see you soon.